All right, so here we go, part 3, business costs and production. All right, so this one, we're gonna get to graphing the cost. That's gonna be at the end of this video. So total revenue, we're gonna first go through all of the calculations. Total revenue, we're gonna be very simplistic in our approach to total revenue. We're gonna assume most of the time that we're just looking at one product. This can easily be expanded if you have multiple products, but it's basically what is the price you charged for that item and how many did you sell, right? So it's price times quantity. And so we have that, that's why this is P and Q. So the abbreviation here, total revenue is equal to price times quantity. Then we're gonna look at total cost. Now, in part 2 of this series, we talked about economic versus accounting cost. Because we're gonna use this with so many different market structures, with perfectly competitive, with monopolies, and monopolies are corporations, they are not sole proprietorships, then we're gonna kind of ignore, or we're gonna set aside the implicit costs for now, right? We always want to think of those, particularly when we're thinking of sole proprietorships. Those mostly exist within the competitive framework, some in the monopolistically competitive framework. But we're just going to set that aside. We want to continue to think about it and think about opportunity costs, but we're going to just set it aside when we're thinking about firms, because we don't exactly know the firm's opportunity cost, right? Because everyone has a different opportunity cost, and a firm is made up of multiple individuals. So that's going to get very, very complicated. So we're going to talk about total cost, and we're going to focus on the explicit costs, right? So total costs, we have 2 costs that we are concerned with. They are fixed costs and variable costs. Now, simply by using the term fixed cost, we are putting ourselves in the short run time frame. And the short run is defined by any period in which you have a fixed cost. The period during which a cost is fixed. So, over time, all costs will eventually become variable. So what's an example of a fixed cost? A fixed cost, if we were being bakers, right? We opened up a bakery. Well, let's say that we signed a lease for a bakery, right? We signed a lease, and that lease tells us that we have to pay rent of $1,500 a month, right, for 1 year. This now tells me that the short run is 1 year, because that is the length of this contract, right? During the length of this contract, I have to pay the landlord $1,500 a month until the contract is up. So at the end of the lease period, right, at the end of the contract period, this now is no longer a fixed cost. Now I can decide to look for someplace else, work from home again, go bigger, go smaller, and those are long run decisions. So short run, we're looking at fixed costs, right? So one great example of a fixed cost is rent. Anything that cannot be changed immediately. All right, so then we have variable costs. Variable costs are those that change with the amount being produced, right? Costs that change with the amount produced. And so that would be the quantity, right? So here are some examples of variable costs. If I'm a baker, it's going to be all of my ingredients, right? How much flour I buy, how many eggs, how much milk, all of those things are going to be part of my variable costs, right? If I want to make 2,500 cupcakes, that's going to help me decide how many ingredients to buy. If I only want to, make 100 cupcakes, then that's going to change my ingredients, right? So they're variable. They're going to change with the level of production. We also tend to think of labor as a variable cost. It is not always variable, right? Again, if you have a contract with an individual, if you say that I am going to hire you for the year to be my accountant or to be my lawyer, that is a contract, and so that is a fixed cost, right? So labor, if you're thinking about, well, I'm going to hire somebody to help me in the bakery, I'm going to hire somebody to take care of the cash register at the front, right? Then you can still decide, hey, I'm not going to open up tomorrow. You don't need to come in. So that's going to be a variable cost. The other one that's particularly important is marginal cost. So we have so far, we have total cost is equal to fixed cost plus our variable cost. And then we're also going to have marginal cost. Marginal cost is going to be the change in total cost over the change in the quantity produced. So it's essentially, here's the definition, it's the additional cost associated with producing one more unit. And sometimes we're not just talking about one more unit. You know, Apple can decide to produce one more iPhone, but if you're a baker, you might be working, one more unit is 1 dozen muffins, right? So we're leaving that open. So again, this means delta, the Greek letter delta, that's the capital Greek letter delta, in mathematics and therefore in economics means a change in. So it's a change in the total cost over the change in quantity. And so this is going to be very important, this marginal cost. And marginal cost, as you might think, is going to be related to our marginal productivity. And just like if our marginal productivity, if at some point it hits a diminishing marginal return, same thing with marginal cost, at some point it's going to be minimized because we want to minimize costs, and then it's going to start to creep up, right? And it's really, the hardest part here is understanding marginal cost, and it's going to go along with marginal revenue. And those two things, at the point at which those two costs, marginal cost is equal to marginal revenue, is literally where we want every single firm to produce, because that will maximize their profit. And we'll prove that later on, right? But this is not an easy concept. Accountants don't do this. And this is also one that's very difficult to figure out while you're in the midst of production, right? Because while you're in the midst of production, I'm trying to figure out, okay, so far I've made 3 dozen, muffins, right? What's my total cost so far? And what's my total cost going to be if I do 3 dozen more, right? That's not an easy question to answer. And this is the hardest part really about applying economics, is that this is collecting information. And anytime you start a new business, you're really lacking a lot of information, right? That's why, there's those statistics of, 2/3 of every new business fails. It's really because it's a lack of information. And as you collect that information, you're making wrong decisions and you're losing things, right? You're losing money and you're losing out. So it's really knowing this information and being able to make a decision based upon it. So we're going to get to the part of graphing here in just a moment. I'm just going to add here marginal revenue, which again, we'll talk more about as we get to the different market structures. Marginal revenue, right? The change in that total revenue over the change in the quantity. So it's the marginal revenue and the marginal cost that's going to drive how we find the highest production, the highest profitability point in the middle of production. Again, not an easy thing to do. All right, so let's talk about our costs. Let me summarize them. So we have total cost is equal to fixed cost plus variable cost, but it's not really the total that we want to look at in particular. The ones that we're going to graph are going to be the averages. So we're going to have average total cost, and we're going to abbreviate that ATC. And so average total cost is simply my total cost now divided by quantity. We're also going to look at average fixed cost. And following the same idea, because it's an average, right? We're going to look at fixed cost which again, this one doesn't change my fixed cost. And again, we're going to divide it by the quantity being produced. So what we'll find here in just a moment when we graph our costs is that average fixed cost is always declining because our fixed costs are fixed, and the more we produce, the smaller it's going to be per unit produced, right? So for example, if I'm paying $1,500, when I make one cupcake, my rent per cupcake is $1,500. When I make 3 cupcakes, my rent is now $500 per cupcake. See how quickly that fell? And if I make 1,500 cupcakes, it's now $1 per cupcake. And if I went up to, 15 million cupcakes, which would be crazy, right? Then it's now negligible per cupcake, right? It's not even rounding to a penny. It's going to approach 0. We'll talk about that. And then we also have average variable cost. And that, of course, is going to be the variable cost divided by quantity. And so because total cost is equal to fixed cost plus variable cost, we also have that it follows average total cost is equal to average fixed cost plus average variable cost. All right. And then we're also going to graph marginal cost, which is the change in total cost divided by the change in quantity. And this one's going to be the biggest difference. All right, so just going to abbreviate this over here. So here's what we're going to see. And again, this is just a general graph. As you do your homework, you'll get your chance to calculate these. All right. And so quantity, always on the horizontal. Price, always on the vertical. And so we'll start with the easy one, right? And so the easiest one is average fixed cost, because again, this is the one that's always going down. So it's going to start high, right? If my rent is $1,500 per cupcake, then my average fixed cost per cupcake is $1,500, right? And then by the time I get to 3, it's like 1/3. So it's, and so as we actually graph this, this is called an asymptote in calculus, where it's approaching 0. It will get very close to 0 very quickly. All right, so now let's look at what are these others going to look like. Average variable cost, we'll talk about this, is going to be very influenced by marginal cost, which again is influenced by marginal product of labor, which is why we started there in part 1. So average total cost, usually what happens is it starts a little high, right? As I hire somebody and they're getting used to things, and then it starts to bottom out. And then because there is marginal costs that are going to start to increase, it's going to start to increase again, right? That diminishing marginal productivity point is going to overtake my costs. And so average variable cost would look something like this, a little bit of a U-shaped. Then average total cost, right, which is equal to these 2 lines, is always going to be the highest of these 3 lines, the highest of the averages, because it's always the addition. So it's going to be pretty high up here. I'm just going to start here. And then it's going to approach average variable cost, just like average fixed cost approaches 0. So the highest line should always be your average total cost, because it's the addition of these 2 bottom lines, right? The last one is marginal cost. And the general shape of this, it's going to depend obviously upon the actual numbers we're looking at. But just like before, marginal productivity, as marginal productivity starts to drop, right, our marginal costs start to rise. The less we produce, the more expensive it is. And so like we often have, it doesn't always have to drop at first. But if we have our second person being more productive than our first, then our marginal costs will start to drop. But as soon as somebody is less productive than the person hired before them, marginal costs start to increase. And they increase rather rapidly, right? And so it looks a little bit more like a check mark than the U shape we see of a lot of these others, right? And so this is the general shape we see of these different graphs, all right? And so let me just mention the average right? Because it's really the average variable cost. That's why this starts to go up, is because of the marginal cost. If you just think of your GPA, GPA is grade point average. If you have a 3.0, which is a B, if you have a 3.0, how do you raise that GPA? You get a higher grade in your last class, the last additional class. So if you get an A, that's going to raise that GPA from a 3.0. If you get a C, that's less than a 3, that's going to drop that GPA. And if you get exactly a B, that's going to keep that the same. So it's the marginal that is influencing the average, right? Okay, so I hope that was helpful, and I'll see you next time.